All right. Welcome everybody to Finance 333. This is the final class. So congratulations, you made it to the last class. Troy mentioned it, but yeah, we're to the last one, and in some ways, this could be kind of scary for a few of you who have got some makeup work to do. But for the others of you, and for a good majority of you, you're caught up, you're ready to go, and now we just need to get you ready for the test this week, the final, and you're done with the class. So hopefully you're in that situation. If you're not, don't get discouraged. You've got plenty of time this week if you manage your time well to get done with everything you need to do. We've still got a handful of folks who need to get some discussion board comments in, need to submit or resubmit assignments, and still need to take a test or two. As we've talked about every single session, I always reiterate and remind that you can always resubmit assignments for additional credit if there was something wrong with them. You can always turn in all coursework up until this coming Saturday at midnight. I will accept it. You will not get full credit for stuff that's turned in late, but you'll get most of the credit. And so I just strongly encourage you to continue turning everything in. We talked about in week one the main difference between people who pass or fail one of these online classes is just whether or not they get their work in. It's not one person is a lot smarter than the other person. Sometimes we think that we're just not smart enough. That has nothing to do with it. If you're willing to put the effort and time in a class like this, you'll pass if you turn in all your work and complete all your assignments. Now, getting an A does require a little bit of extra effort, as we all know. I mentioned at the beginning of this course in Mod 1 that if you are close to the grade that you were trying to get from this class and have turned in all your work, you're welcome to zip me an email and I'll respond with some feedback on what we can do to improve our score. Okay. So, yeah, Troy, there is a chance of that, so you can email me. I'd rather have you take the final first, which requires you to do the final earlier on this week. And the reason for that is it doesn't do us a lot of good to get you some extra credit or have you retake something. And then if you bomb the final, or if you do really well in the final, that would have changed, whether or not we should have done that extra credit or not. Does that make sense? So I'd rather have you study, do the best you can on the final. Don't rush it, but do the best you can. And if you can get in touch with me by Thursday or Friday this week, we can get you some feedback on what it is that you can do. I will be out camping Thursday to Friday. I'll be back Friday night late. So I'll be checking things, either Friday night really late or first thing in the morning Saturday. So it still gives you Saturday to retake a test or, redo something if you need to, with some feedback from me. Yeah, right, Christina. None of us take vacations, right? July is just a crazy, crazy month. I've already had a few, and hopefully you felt like I've kept in touch with you, but we've had a few of those. Yeah, Troy. No one gets a vacation. Anyway, so one of the things, obviously the most important thing we need to do tonight is get you ready for the test. We need to cover a little bit of the material from chapter 15, but the most important thing is a 38 problem final exam that you have this week, right? So the final exam is mostly true-false questions, intermixed with some multiple choice questions. But the most important thing, like I say tonight, is that we get you ready, at least with the topics for this coming test. There are 38 problems. It is comprehensive from all the chapters we've covered so far. And so what I would do on the final is what I would, is the same, is consistent with what I told you to do for previous tests, and that is take careful notes on the topics that I tell you are going to be on the test, and then search within the ebook for those topics and read up on those topics so that you feel comfortable with them before you get to the test, not during the test, before you get to the test, that you've studied up on those topics and have a deeper understanding of those topics than just the first line that you find in the book or the first thing that you find if you Google search that topic, okay? If you have a little bit deeper understanding, then when you get to the test, you should be in better shape, okay? Troy, I don't know that I will. Most of the test problems come from, the text, and so I don't want to have people, spending a lot of time studying slides when it's the text, it's the chapters that have the content that the test comes directly from. I did post, last week's slides by request, but I think I will hold off on posting all the slides from all the classes unless somebody emails me and just has a really good reason for that. I just don't want to confuse the amount of time and effort that you should put towards the book and the topics, right? I don't want you thinking that you need to know all the material from the slides, because frankly you don't. You need to know more of the material and the descriptions from the book and how the book describes it. So anyway, that's my short answer to that. But if somebody can give me a really persuasive argument as to why we need slides from previous weeks, I'm happy to do it as well. Okay. So let me know if that applies. Okay, so I mentioned number 1 goal tonight is the test. Number 2 issue is we need to cover some of the material from chapter 15, of course. But before we do either one of those, I did want to spend just a second, and I realize that this is, review for some of you, but I did want to review for just a second because I committed to Troy that I would, and take some time on last week's assignment for a minute, just how you set up the math for the assignment. So if you'll bear with me, let's spend a couple minutes and review that math. For those of you who already turned in the assignment, this is an opportunity just to review how you did it. If you did it wrong, as we've talked about for all the assignments, you're welcome to resubmit it, rework it, resubmit it for some additional points. If you did it right, then you'll probably get a pretty good understanding that you did do it right, or confirmation that you did do it right based on what we talk about tonight. Okay, so hopefully there's some value to it either way, but I do think it's important. It was a challenging enough assignment, that I think it would be helpful to do this. Also, as always, I'll have your work graded by tomorrow at noon. I've gotten everything graded but the assignment. So any work that you've turned into this point should have a grade on it. If not, zip me a quick email so that we can get our attention to whatever it is that you need right away, okay? Anything that we might have missed, excuse me. All right, so really quick, let me share a different screen here for a second. All right, so the question is, can you see my desktop at this point? Can you see the book, the end of book? Okay, so really this is more for me than it is for you, meaning you don't need to see this, right? Because you can look it up on your computer anytime and find it. The reason I've got it pulled up is, and the writing might be too small for you to even see it anyway, but the reason I've got it pulled up is so that I can read it and so that I can go through it with you, not necessarily so you can see it. You can pull it up after we're done. You can pull, you've already seen it, so you don't necessarily need to see it, okay? All right, so letter A on the assignment this week is just a conceptual thing, comes right out of the chapter, just your opinion based on the situation, whether or not they should use an option or not, and what are the advantages and disadvantages of using a hedge, okay? And in this case, the hedge would be buying a put, or in this case, 3 puts, right, in order to hedge the price of this particular stock. Now, so that's A. So we're not going to spend a lot of time on A, but when we get to B and C, both B and C have some math associated with them, and we need to just understand how to set up the math so that you feel comfortable with it, so that we can get the answers correct. So letter B asks, what will Luke's minimum profit be if he buys 3 puts at the indicated option price? Okay, so the option price is $550 per put, and you're buying 3 puts. So real quick, this isn't hard math, right? How much is the cost of the 3 puts? So 550 times 3, right? So my total cost for these puts is $1,650. That's exactly right, Christina. So that's my cost for the puts. It's very important to understand what the cost is, because that's one of the basic issues that we're dealing with when it comes to solving this problem. Now, second step, what is the profit? What is the profit if I were to sell the stock today? So that's going to be important to letter C, but let's just calculate this out. So if I bought 300 shares at $40 per share, how much did it cost for me to buy these shares? 300 shares times 40, 12,000, right? Real straightforward, right? Then if I sell them at $75 per share, 75 times 300, Okay, does anybody have that offhand? Yep, Christina, you've got all the math here. So what is my profit if I sell it today without the put? Is anybody going to help Christina out? Thank you, Christina. Everybody's like, nope, Christina's doing a great job. This is awesome. Okay, so Christina's got 10,500, and that is right. So without the put, if I were to sell the stock today at $75 per share, okay, at $75 per share, then I get $10,500 in profit, okay, from this trade. Now, if we add the put, okay, the put cost we decided was $16.50, right? $16.50 is my put cost. So if everything, if I buy the put, I don't make any money on it. In fact, I lose my entire cost of the put. How much money do I make on this trade? So is 88.50, 16.50, excuse me, 10,500 minus 16.50? Does everybody agree with that math, 88.50? And I'm not saying that because I'm second guessing you. I just haven't put it in my calculator. So 10,500 is the profit, right? If I minus out 1,650 for the price of the puts, I get to 88.50, just like you said. Okay, so perfect. All right, so this is the minimum profit that I can make. Why is it the minimum profit that I can make? Who can just give me a quick explanation on why that's the minimum profit that I'll make if I buy these puts? Why is it that that's the minimum that I'll make? Be a little bit more. Okay, so what I'm doing, right, conceptually is I'm making sure that after my cost for these puts, I basically can't lose any more than that amount, right? It's basically saying I paid $1,650 for insurance, just like you said, Troy, okay? It's basically like an insurance policy that I paid $1,650 for, okay? And that insurance policy, based on the person who sold me that put, basically says, hey, we're willing to guarantee that you won't lose on your position more. You'll never be down more than this amount, okay? Does that make sense? So if we were to change the scenario just a little bit, and I don't do this to confuse you, but if we were to change the scenario a little bit and say we bought the stock at $40 per share and today it's $40 per share, we haven't made any money on the stock, right? If it's $40 per share today and we bought it for $40 per share, we haven't made any money. And then let's say we go out and buy these puts at $40 and we pay $1,650 for it. Worst case scenario, okay, worst case scenario is we lose the money that we put into the put, right, the $1,650. But what's the worst situation that could happen if we don't have the puts? What's the worst situation if we don't have the puts in place? That's exactly right, Troy. And this is a really important concept, Frida. Great. You guys are right onto this. The important concept here is this is a stock, and stocks are always this way. They can go to zero, right? If that company goes bankrupt, you get zero for your investments. So even though it seems, you might say, well, that's crazy. If you haven't even made any money on a position, why would you buy puts? Why would you hedge them? Well, the reason you'd hedge them is because for $1,600, $1,650, you have zero risk to the account losing all your money, right? You limit your loss basically by doing that. And there are other ways to limit your loss as well, but puts are a very efficient way to do that, okay? Okay, so back to part B. We talked about the minimum amount that we could possibly gain from this situation is $88.50, right? So that's the first part of Part A. The second part of Part A says, what if we didn't hedge and we just immediately sold the stock? Well, this is kind of going backwards on something we already talked about, right? We would get our 10,500. Does everybody get that? So if we didn't do the puts and we just sold it, we would get what the stock is worth, which is $75 a share, less the amount we put in initially, for a total profit of 10,500. So here's the question in Part B. If you are able to profit at 10,500, okay, isn't the put making it so you're going to make less money? The answer is yes, if the stock goes up or stays the same. The answer is no if the stock goes down, right? If the stock goes down, it protects you from losing all your money. If the stock goes up, it actually hurts you, okay? Because if the stock goes up, you're going to lose out on some of that profit based on the fact that you bought those puts and paid that money for those puts, okay? All right, so on letter B, the second part, we've already calculated the profit that you would get. So we calculated the minimum profit we'd get with the puts, which is lower than the profit that we'd get if we just went ahead and sold them today. Now, some people don't sell today because they have tax consequences of selling and they don't want the tax issues. So they'll go out and buy puts in order to make it so that they don't have a risk of losing all their money, but they also don't have to sell it and take the loss, or excuse me, and take the gains and pay taxes, okay? And that's true, Christina. If you're out of the money though, then you lost the premium that you paid, right? So, and this will come more into play on Part C, right? Because in Part C it says what happens if the stock moves to $100 and what happens if the stock moves down to $50, okay? So first of all, if it goes up to $100, what do you get from the stock without even worrying about what the hedge was, without the puts? So if they're $100 per share and you've got 300 shares, that's $30,000, right? And initially we said we paid $12,000 for the stock. So that'd be an $18,000 profit. Okay, an $18,000 profit. Then we have to take into respect the fact that if we did hedge the position, right, then we have to take out our premium for the hedge. Okay. So we made $18,000 profit on the stock, but we paid $1,650. Right? Yes, Christina. I keep seeing your first number and thinking, oh, shoot, what did we do wrong? And then you correct it. Yes. So that's the profit if the stock goes up to 100. If the stock goes down to 50, okay, what happens in this situation? Because our put makes money in this situation, right? That's right. Because you have the puts, you can still make $75 per share, but you still have to pay for the puts, right, Christina? Okay, so we get $75 per share on all 300 shares, but whatever that amount is, then we have to take out the $1,650 that we paid for them, right? And that gives us our net profit. This question is exactly the same as the first part of Part B. Yes, perfect, Christina. It takes us right back to that minimum profit, because even though our stock got cut significantly down, right, we have this minimum amount that we're going to get no matter what, based on the fact that we have this hedge, these options in place. Okay, if we didn't have them in place, then at $50 per share, we would have only made $3,000 profit. But because we did have the hedge in place, we made $8,850. We made almost $4,000 more dollars, even after our expense of the options, because of the fact that we had those puts in place. Okay, if we wouldn't have had the puts in place based on $50 share price, we'd have only made $3,000 profit. But because we had the puts, we made almost $5,000 more. Okay, in a scenario where the stock goes down. Now, in the scenario where the stock went up to $100 a share, you know, basically the put option didn't help us, right? It actually hurt us because we lost 1650. We still made really good money. Okay, we still made really good money in the scenario where it goes up to $100 a share, but we lost, the 1650 for buying the insurance basically that we didn't need. All right, Troy, 75 times 300. Nope, we don't have to pay that for the put option. That's the share price, right? That's the share price that we're guaranteed to get because we have the put option in place. So we take the 75 times 300, then we minus out the premium we paid for the option, and it takes us right back to that 8850 that we already have calculated in Part B, which was our minimum guaranteed profit based on the fact that we had put the hedge in place. Okay. Christina, great job. It looks like you really, either the tutor did a great job with you or you just really are on top of this information. But at this point, all of you have the information you need to get all these answers right. Okay, it's the math that gets people a little bit freaked out on these problems, right? Parts B and C. But now that you have all the math, we've given it to you, we've talked about it. If you need to, just resubmit your assignment and I'll give you additional points on it if those were parts that you struggled with, okay? And for all of you who maybe have not turned in the assignment, a big gift was just given to you. We've gone through kind of the hardest parts of the assignment from last week, and there's no excuse not to get, the assignment from week 3 turned in at this point, right? You've got all the information you need, you've got all the steps, you know most of the answers thanks to Christina's math in the chat, on the chat side of things. So yeah, I just strongly encourage you to just spend a few minutes and get this thing knocked out, resubmit it if you need to, get it turned in if you haven't yet, and let's get those points. 120 points for something that we've given you everything you need to know to get it done very easily now, okay? All right, any other questions with the case problem before we continue tonight? That's okay, Troy. We got you covered this evening. And I think thanks to your question on it, I think a lot of other people will really have been, I think a lot of other people will really appreciate the fact that we covered this. Even if they've already turned it in, like I say, they might want to resubmit. So, okay, let's go back to slides. Can everybody see slides? Okay. What are we waiting for? Christina, we need to make sure that you get in touch with Mary and Troy, it looks like. All right. Okay. So tonight we're talking a little bit about, and I say a little bit, we're only going to spend 10, 15 minutes on the slides. We're going to talk a little bit about commodities and futures, the futures market and commodities. Basically, these are a little bit more obscure marketplaces. We talked a little bit before about the fact that stocks and bonds and all their derivatives and options and everything, mutual funds and everything that's built off of stocks and bonds really make up the cornerstone or foundation of what we'd call the financial markets. Then you have, you have currency, you have the FX market, which is currency, different currencies around the world. You have commodities that we'll talk a little bit about tonight, like gold, silver, corn, all kinds of different things. Potbellies, which are pigs, hogs. So there's all kinds of different commodities out there. And then there's this marketplace that really deals with commodities, but it's called the futures marketplace. And the futures marketplace basically is an opportunity for people to lock pricing like you did on the options contract last week, for the assignment. But it's an opportunity for folks to lock pricing on commodities in the future. okay, or on investments in the future. So like a call option or a put option, call option was the right, to benefit from the upside of a price, of a stock or a bond in the future. And a put was the opportunity or right to benefit from the downside of a stock or bond in the future. Well, the futures market is basically the same idea, but we're using commodities, foreign exchange, currency. We can use the stock market. We can use bonds in the futures market as well. Okay. So let's talk about what we're even talking about here. What's the biggest issue here? Well, here's a list of different futures contracts and different examples of futures. Okay. So what are we looking at here? If I am a corn farmer, okay, let's say I raise corn, I farm corn, and the price of corn right now is a certain amount per bushel, okay? And I'm concerned that between now and the time I harvest in a month or two, or let's say even next year's harvest, that corn prices might go way down and I might lose a bunch of money because I can't sell my corn today, right? I only can sell my corn after I harvest it. So the reason that the futures market originally came into being and existed was because farmers needed a way to hedge the price or lock in the price of the things that they grow. And they needed to be able to lock it in because they need to be able to anticipate pricing so that they can plan for expenses and different things that they incur throughout the year as they farm. Okay. And so corn futures are a way for a farmer to say, okay, I'm going to pay a premium, I'm going to pay a price to lock in my future price for my corn so that I know what I can anticipate. Then if the corn price goes down, I'm locked in, right? If the corn price goes up, I'm still locked in, okay? So I limit my upside, but I limit my downside. And the most important part is limiting the downside so that in a volatile commodities marketplace, if corn were to go down significantly, that could put corn farmers out of business, right? They might have to sell their farm. They might go bankrupt. So the way that they protect themselves is they buy these futures contracts, agree to a futures price, and then they don't have to worry about what the price of corn does between now and the time that they harvest. Okay? So that's the example with corn, but that's really the main driver and reasoning why the commodities marketplace or futures marketplace came into existence years ago. And then over the past, I would say, 30 years, we kind of morphed into a little bit different situation with the futures market. We came away from just a group of farmers and interested parties, doing these contracts, to where now anybody off the street can play the futures market basically and speculate on whether or not they think a price of a commodity will go up or down. And depending on which direction they think it'll go, they either sell the contracts, okay, or they buy the contracts. If they want to lock in a price in the future that's above where it is now, okay, or at the price where it is now, they might buy a futures contract at today's price in the future. The flip side is that, if they feel like they can make some money off the fact that the commodity price might go up, then they might be a seller of those contracts to someone else. Okay, there has to be a buyer and a seller, though, in order for that futures market to exist. Okay, so do you see, like, we've got cattle, we've got hogs, we've got coffee, wheat. There are some things that are missing. For those of you up in Idaho, you're not going to see potatoes on this list. Actually, interesting story on that topic. Simplot, which is your main potato farmer up in Idaho, back in the day, tried to manipulate the futures market for potatoes. And because of that, potatoes are no longer part of the futures market. So if you're a potato farmer, you don't get to participate in the futures market to try to hedge your product because basically a baron back in the day, or farmer baron back in the day, tried to manipulate the price of potatoes, and so they delisted it as an option. So kind of an interesting story if you're curious, if you're from Idaho, or if you just really like potatoes and want to learn about it. Silver's not on this list. I think just gold is, right? Let me just, I'm moving my stuff around. Yeah, gold's on there, copper's on there. Silver is a commodity future that you can buy. This isn't a comprehensive list, by the way. This is just an example of some of the things that you can do, okay? Almost any commodity you can buy a futures contract on, with a few exceptions like we talked about, like potatoes, okay? You'll notice at the bottom, we have the bond market, we have treasury bonds, we have currency, and we have the stock market that we can buy futures contracts on as well. So interestingly enough, if we wanted to buy the stock market index like the S&P 500 at an agreed upon price, we could do that. Then if the price of the market went down, you'd be protected because you had a guaranteed contract at a certain price. So some very interesting contracts here, different ways that you can do futures contracts. Here's some different characteristics of futures contracts. Okay. You have agreed upon times and dates in the future that you're going to have these, delivery of this product. Okay. It's legally binding, right? And then finally, and perhaps very importantly, a difference between the futures marketplace and just regular stocks, bonds, and mutual funds is all of the buying and selling in the futures marketplace is done on margin. And what is margin? Margin is leverage, another word for leverage, and it basically just means that we're borrowing money in order to lever ourselves or accomplish the contract that we're purchasing. And of course, anytime you borrow money, there's a cost of that, right? There's a cost of doing that business, an interest cost associated with borrowing those funds. But also, and perhaps an important element that we need to not overlook is the fact that because you're borrowing, because it's leveraged, because we're using margin, there's increased risk associated with these types of products if we're speculating. Okay, if we're just locking in a future price to hedge our farm product like our corn crop, then we're reducing our risk, right, by doing that hedge. But if we're speculating on corn and we don't even grow corn, right, and we're using margin or leverage to do that speculation, then we enhance our potential for loss, okay? Because we're not trying to hedge any kind of product. We don't even have the product. And when you're not creating a hedge on a product, we're not going to benefit if something goes against us, right, like we would on the hedge. And so if we're just speculating, we could lose a lot of money when it comes to futures if we get it wrong, if we guess wrong, okay? Talks about high risk of it because we're levered, right? And there's no limit on the exposure of what we could lose. So a little bit of the differences, this just line items some of the differences between futures that we're talking about right now and options. Options, remember, is just the right to buy something. We don't have to buy it, we just have the right to buy it if we'd like to buy it, okay? That's why when you have a call option, if the price of something goes up, that gives us the right to have bought it at the lower price, and we benefit on the price, between what we bought it at and what it's gone up to, right? And if it goes down on a call option, we don't buy it. All we lose out on is the cost of the call, right? But when it comes to a futures contract, we have to deliver, okay? We have to accomplish whatever we've agreed to. There's not a right to maybe or maybe not buy it like there is on options that kind of protects us. On futures, we have an obligation to do it, okay? That's why there's more risk with futures if we're not hedging something, because we have to do it. It's not just an option to do it or not do it. We actually have to do it, okay? The CME, in Chicago is the largest futures exchange. It's where most of the commodities futures take place. That's why when you are watching CNBC, if you ever watch CNBC and they're doing news reports, when they start to talk about oil or gold and silver or anything that's commodity based, they'll usually go to a reporter in Chicago at the CME, which is the exchange for commodities, futures on commodities. And then when they go back to talking about the stock market, they usually go back to the New York Stock Exchange, which is one of the largest exchanges in the world for stocks, right? So a little bit of background on that. So here are your two main categories of folks who are buying futures, and we've kind of already alluded to this. You've got your hedgers, and then you've got your speculators. Hedgers can be more than just farmers nowadays, okay? Let's say you're Apple, right? You build iPhones, iPads, all kinds of different cool devices. And let's say you use a lot of silver in your products that you build, okay? So a big manufacturer like Apple needs to have some predictability and some security associated with the commodities that they use to build the products that they build. So if they do use a lot of silver, they might hedge, okay? They might hedge the price of silver by buying and locking in futures contracts for silver at a certain price so that they can know, okay, with a surety how much they're going to pay for their silver in the future with their manufacturing that they're doing, okay? So that's a pretty cool thing, you know, that big manufacturers and large businesses around the world can protect themselves against the price of something going way up by locking in that input cost by buying a futures contract. Another example of this is airlines, okay? What's the most expensive input that airlines use? Jet fuel, right? Oil. That's the most important cost to what they do. So what happens when oil prices go way down? Airlines make a lot of money, right? Their margins get really good. They're highly profitable. So right now, airlines are highly, highly profitable. But what happens when oil goes way up? You have airlines like Delta go bankrupt. And Delta's gone through bankruptcy twice. 2 different times historically when oil prices go up, Delta Airlines has gone bankrupt, okay? They've needed bankruptcy protection. They've come out of it, and now they're still Delta Airlines, but this is a company that's been through bankruptcy a couple times now because of the price of oil. Now, what has Southwest Airlines done historically better than any other airline? They've hedged the price of oil, okay? So instead of allowing the price of oil to dictate their profit, they've locked in their future oil price, right? They've locked it in through futures, and then they've been profitable when oil prices have gone way up. Okay. So Troy, are you saying they can't afford the price of the futures contract, or are you saying they can't afford the pricing of oil? Yes, you're absolutely right. The reason Delta Airlines went out of business twice before resurrecting themselves through bankruptcy court is they can't afford the cost of oil. What happens is you and I book our flights months in advance, right? And then they're buying oil at the time that we're actually flying. So they can't change the price on us because we already bought. But they failed exactly. They absolutely did fail. You're understanding it perfectly well, Troy. They absolutely failed to protect themselves against the potential price increase of oil, and not even the potential in the case historically, right? They just messed up both times. Not planning ahead well enough about what the price of oil would do to their business. In the long run, the consumer did, because if you and I bought Delta stock, Troy, we got zero. Let's say we paid $30 per share back in the day for Delta stock. Then they go bankrupt. We get nothing back for our investment. We go to zero. They're still in business. They're still making money. The folks that work for Delta are still making money. But you and I as consumers got stuck with the bill. That's exactly right. Yeah, Christina, that's an interesting point. If you know that you're going to be able to get bankruptcy protection, then why even hedge, right? Because you'll be able to get out of it anyway. And I guess what I would say to that is that I would much rather, if I'm an executive, for example, of Delta, it's highly likely that I have a lot of Delta stock. Okay, most executives get paid, quite a bit of their income comes from stock. And so you would think that those executives would have been highly motivated to protect their stock and share price. They just didn't do it. Going forward, we would hope, Christina, because we're paying, they're paying those executives a lot of their compensation in the form of stock, that they would be motivated to protect the stock and protect shareholders before anything else. Yeah, and Troy, I think it comes down to the same idea as like GM and Chrysler a few years ago, when the government had to step in and basically protected them. Let their bond investors go to, let the stock investors go to zero on GM and Chrysler, but still allowed those two companies to recreate themselves and come out of what basically was a bailout or bankruptcy. And what the government basically says when they do those kinds of things or allow those kinds of things is that those companies are just too important to the economy to allow them to just go away, right? And whether or not you agree or disagree with that, that's what they've decided, right? And it is true that there's thousands and thousands of jobs associated with each one of these companies. These are big, big companies, right? Delta Airlines is huge. And so there is something to that. But anyway, airlines are one of the biggest users of futures hedging. And at any given point, it's not very clear how much any given airline is hedged. Some of the airlines are a little bit more forthcoming in their quarterly reports on how much they're hedging or how little they're hedging. But the challenge for them is, and this is what Southwest Airlines is dealing with right now, if you're a company that's very aggressively protecting yourself by buying hedges and buying futures locked oil prices, and then oil goes down significantly like it has recently, companies like Delta and United and what used to be Continental, companies that don't hedge as much, significantly benefit by not having the hedge, right? When oil goes down. It only helps them when oil goes way up. Okay, so it's actually hurting Southwest Airlines right now because they have hedged a lot of their oil, but oil pricing has gone way down. So they didn't need that hedge right now. When they need the hedge is when oil prices have gone way up. Okay, so that's futures contracts in a nutshell and some examples about futures contracts. Let's see here. Here are the major classes of commodities. You can see metals. We've got silver on there. You had asked. So these are the main categories, and then the different types of products that are in them. And this isn't an exhaustive list again, just some different examples. You'll notice that on the other category, there's some interesting ones. The environment, with the weather, what interest rates might do. All kinds of things that you can buy futures contracts on and hedge. Okay. All right, so I think that's all I want to cover as far as futures and commodities. But any questions that you have before we kind of change gears and really focus in or hone in on this week's test? Okay, everybody's like, all right, just get on with it. We want to hear about the material for the test, right? Okay. All right, so let's go to test material. Troy's like, yes, already. Come on, let's get going. All right. So as far as test material is concerned, I've already mentioned this, but just to reiterate, 38 problems. Most of them are true-false. I will tell you right now that I would actually prefer, if I was writing this test, to have mostly multiple choice questions. I think true-false questions make a lot of people kind of crazy because they second guess themselves a lot on true-false questions, where on multiple choice questions, usually the answer is a little more straightforward. Sometimes on true-false questions, you just need to be very careful about how you word the question, right? How they word the question could trick you one way or the other. You've got to be very, very careful about the question. Read and reread the question. Make sure you have a very good understanding of what the question is asking for and whether or not the question is asking for the exception or the rule, right? Because sometimes they'll be asking for what's right, what's false about it, and what's true, or what's true about it, but they might be asking for the opposite of what you're thinking they are if you misread the problem. Okay. I'm with you, Troy. Like I say, my preference would be multiple choice. This is a test that the school, puts together. I don't have any, say over what happens in it except for future classes. So, if you've got some input, you could give it on this little quiz that you get to do, the career development quiz that you do at the end of this class. Gives you an opportunity to give me some feedback on what we could do with this test going forward, but nothing I can do about it for this particular class. This test was already created. Okay. Good try, Christina. Good try. All right, so number 1 on the test. Christina, you got a great personality. If you all don't know Christina, you need to get to know her. She's awesome. All right, so and oh, by the way, I'm going to post this, but kudos to Christina, by the way. Kudos to Christina for bringing my attention to Thursday's checkpoint last week, which was completely bogus. The question had nothing to do with the material that was provided. And so I awarded the entire class 100% on that checkpoint from Thursday's checkpoint because Christina brought it to my attention. So kudos to Christina for bringing that to my attention, and everybody got credit for that checkpoint because of her email. So thank you. All right, material. We need to get going on this. So number 1 on the test is a true-false question. Basically, you need to know how to calculate the real rate of interest. Okay, just write this down. Real rate of interest. How do you calculate the real rate of interest? Whenever you see the word real, okay, when it comes to financial concepts, you immediately can think in your mind, this has something to do with me calculating something after inflation. Okay. When we talk about the real return or the real rate, we're talking about a rate or return after we take into respect inflation. Okay. So you want to know what the real rate of interest, how it's calculated. That's number 1 on the test. Number 2 on the test. You'll want to know the difference between municipal bond yields and U.S. government bond yields. Which one pays more and why do they pay more? Okay. Which one pays more, municipal bonds or government bonds, U.S. government bonds, and why? And you'll get number 2 on the test right. Okay, this goes back to when we talked about bonds. When we talked about how municipal bonds are tax-free, U.S. government bonds are not tax-free. So U.S. government bonds will pay a different type of yield than municipals because of the fact that municipals pay tax-free. I'm not going to give you any more of the answer than that, but you do need to look up and make sure you understand which one pays more and why do they pay more before you get to the test, and number 2 on the test. Number 3 on the test. What is the risk premium component of a bond interest rate? Okay, what is the risk premium component of a bond interest rate? Okay, what is the risk premium component? So what does that even mean? Why is there a risk premium component? What does that mean? If you understand what it means when you get to the test on number 3, you'll be in good shape. Number 4 on the test. Number 4 on the test, you need to understand the relationship between ratings and yield. The higher a rating is on a bond, the lower the yield will be. Why? Because you and I as consumers will demand less coupon, or another word for coupon is yet less yield, less interest. We demand less interest from companies that are higher rated. If you're going to invest in a company and buy bonds from a company that's got a very low rating, you're going to demand a higher yield from that company. But if they get a very high rating and they're very secure, you're going to demand a lower yield or lower coupon from that company. Okay? So number 4, if you understand the relationship between yield and ratings, you'll get number 4 on the test right. Okay? Number 5 on the test, you want to understand the relationship between inflation and interest rates. There was a graphic that we showed when we talked about interest rates and inflation and different impacts on bonds. And when we talked about inflation, we mentioned the relationship between inflation and interest rates. You're going to want to know what the book has to say. Don't go Google this. What does the book have to say about the relationship between inflation and the direction that inflation is going and interest rates? Okay? And if you understand the relationship there, whether or not it's an inverse relationship or direct relationship, you will get number 5 right on the test. A direct relationship would be one goes up, the other goes up, right? An inverse relationship would be one goes up, the other goes down. So you'll want to know whether or not it's a direct relationship or inverse relationship before you get to the test on number 5. And again, that's the relationship between inflation and interest rates. Number 6 on the test, you're going to want to understand, I think this is a repeat question from a previous test, but you're going to want to understand the pros and cons of mutual fund investing. So the book talks about things that are great about mutual funds, advantages like professional management, economies of scale, diversification, those types of things. And then it also talks about a few, potentially what you could refer to or think of as negative things when it comes to mutual funds. And you're going to want to know what the book has to say about the pros and cons before you get to question 6. Question 7 on the test, you're going to want to know what type of company or what type of institution usually acts as custodian for mutual funds. What type of company, what type of institution usually is the custodian for mutual funds? Okay. Custodian just means who holds the money and moves the money around. Okay. So mutual fund managers usually don't hold the money and move the money around. They have a custodian do that. Okay. What's called a custodian, not the person who cleans up the garbage after them, but a custodian in a financial sense, which means those are the folks who hold the money and move the money around for the mutual fund company. So there's a certain type of institution that is going to act as custodian for most mutual funds. You just need to know what type of institution or what type of company those usually are, and you'll get number 7 right on the test. Okay? Who serves as a custodian for a mutual fund company? And again, we're not talking about custodians that clean things. We're talking about custodians that help move money around for the mutual fund company. Okay? Number 8 on the test, you're going to want to know what it means that a mutual fund company is a regulated investment company. Okay? What does it mean when we say that a mutual fund is a regulated investment company? And I think, once again, this is a repeat question. Has to do with the taxation on mutual fund companies. But you're going to want to know why we refer to as a mutual fund, we refer to mutual funds as regulated investment companies. Why is that? It's in the book. Look it up in the book, and you'll get number 8 right on the test. Number 9 on the test, just you need to know what it means to be an open-end investment company. Okay, most mutual funds are open-end investment companies, mutual fund managers. Most mutual fund companies, like a PIMCO or a Franklin Funds or American Funds or Fidelity or Vanguard, most of these are open-end investment companies. Okay, so what does it mean to be an open-end investment company? And what do open-end investment companies do? Okay, so you have closed-end investment companies, you have open-end investment companies. What are the main differences between them? If you can get that and know basically what an open-end investment company is, you'll get number 9 right on the test. Number 10 on the test asks you about closed-end funds. What's the difference between closed-end funds and open-end funds? If you understand the basics of a closed-end fund, what it is, why it's different than an open-end fund, you'll get number 10 right on the test. Number 11 on the test talks about a conservative asset allocation. Okay, I think this is a repeat question as well. Basically just asks you to understand the difference between stocks and bonds as far as risk. Remember, stocks are more risky than bonds. Bonds are more conservative, right? Bonds are like debt. Stocks are like equity in a company or ownership in a company. The stock ownership of a company has more upside potential, but it also has more risk. So if the test asks you what you should do if you're a very conservative investor in a portfolio, you should probably focus your portfolio more on bonds. You still mix in some stock, but you'll have more bonds than stocks. If you're a really aggressive investor or high growth investor, okay, maybe you'll focus more on stocks and maybe have less bonds. Okay, so if you understand that, you'll get number 11 right on the test as far as allocation to stocks and bonds, whether you're conservative or aggressive. Number 12 on the test, is an order of operations question. I do think this is a repeat question from a previous test. Order of operations meaning, how do you come up with your portfolio? Remember, we talked about how you manage your own investments, and the book goes through some steps. If you're going to manage your own money, it outlines some different steps that you should go through before you pick your investments, right? Before you ever pick your investments, there are some steps associated with determining your objectives. Do you remember that? Determining your risk, or determining your time frame. Those kinds of things need to be determined before you ever start to look at different individual investments. Okay? So you need to remember what comes first. And the question, number 12, which is a repeat question again, is kind of tricky. Because basically it says, it's a question that's worded kind of strange. So just make sure and read and reread the question on number 12. You understand exactly what it's saying, knowing that you should do those steps in order, right? We shouldn't come up with a portfolio and have our investments before we come up with our objectives, whether or not we're long-term, short-term, high risk, low risk. Those types of things need to come way before we start looking at individual investments, okay, and put our portfolio together. So order of operations question on number 12 should be pretty straightforward, but just know what the book says about managing your own money, the steps associated with determining what you should do. Number 13 on the test, you need to understand what the book has to say about utility stocks. I think this is also a repeat question, getting a lot of repeat questions, so if you remember this material, you'll be in great shape. But you need to know what the book has to say about utility stocks. Are they generally more aggressive, or are they generally more conservative? Okay. Number 14 on the test asks about asset allocation and whether or not you weight each of your categories exactly the same. Okay, we talked about this for a previous test. I think it was last week or the week before, and we basically said it would be silly to equal weight every single category, because based on your objectives, right, how much risk you're taking, how long-term you are, you would want overweights to things that match your objectives, right? And then the rest of the portfolio has underweights, but it's still there so that you diversify well. Okay, so that's a true-false question regarding equal weighting and asset allocation, and whether or not we should or shouldn't. Number 15 on the test. Number 15 on the test should be really intuitive. Don't second guess yourself on this one. Basically, it just is asking you to understand whether or not you should understand your own objectives before picking an asset allocation. And of course, you should understand your objectives before you pick your investments. Okay? So that's a repeat question, and it's really straightforward. Don't second guess yourself on number 15, because it's as easy and straightforward as it sounds. Do we need to understand a situation before we pick investments? And the answer, of course, is yes. We need to understand the situation to get the right investments. Number 16 on the test is an options question, okay? So it's just asking what stock options are, basically. So if you understand what a stock option is, you're going to get number 16 right on the test. Number 17 on the test is a rights question. I think it's a repeat question from last week, but just make sure you understand what the book has to say about what rights are. So generally, you need to understand what options are, and generally, you need to understand what rights are. Okay? For those of you who need to drop off, we're at 9 o'clock. You're welcome to drop off. This will be recorded and be available to you, so if you need to, you can come back to it and listen to the recording to take the notes. But I'm going to continue. We'll probably be another 5 to 10 minutes. Okay? Okay, we need to understand what the terminology means when we talk about the maker of a put or a call. Basically, that's the seller, right? We've got a buyer and a seller when it comes to puts and calls, when it comes to any option. And the person who's making the put or call, that's also referred to as the seller, okay? Or could also be referred to as the writer of the put or the call. Okay, so you got two sides to every option. Every put or call has a seller and a buyer, okay? And the seller is also referred to as a writer or maker of the put or call as well. You need to know that for number 18 on the test. Number 19 on the test, you need to understand what it means to be a writer of an option, okay? A writer of an option profits or loses depending on the situation, okay? And so you need to understand how the writer of an option makes money. Okay, how does that person make money? Whoever's writing options or making options, how do they make money? Number 20 on the test is asking you, it's a repeat question. I know we saw this before, but which one of the exchanges, right, out there was the one that is one of the first ones that started trading options? Okay. Where's one of the first exchanges? Is it the New York Stock Exchange, the Chicago Board Options Exchange, the Stock Index Board, the Philadelphia Board of Trade? Where did options first start trading in the United States? If you know what the book has to say on that, you've got it right. Number 21 on the test talks about biases. This is something that we spent a little bit of time on one of the assignments about, right? And you need to just make sure you understand those different biases that we answered that question on the assignment about when it comes to investing. Remember, we had like overconfidence, representativeness, if I can say that word. It's getting late, I guess. Familiarity bias, loss aversion, those are all different biases. And so you want to make sure you understand the basics of each one of those biases so you can define them and identify the answer to those biases on the test. Okay. Number 22, you want to understand what the objective of technical analysis is. Another question that comes right out of the assignment from 2 weeks ago when we talked about what is technical analysis. Why would anybody do technical analysis? Okay, if you understand the why or the objective of technical analysis, you'll get number 22 on the test right. Number 23 on the test is you need to understand the issue of flight to quality. What does the book have to say about flight to quality? What is flight to quality? It's pretty intuitive. It's basically just when things seem crazy in the world, we have what's called a flight to quality, where people will tend to invest in the most conservative things out there and drive the most conservative things up in price. Okay. One of the most conservative things that we can invest in here in the United States are government bonds. So when the world's pretty crazy and the stock market's pretty volatile, people will tend to sell those volatile things and go into something that's very conservative, like federal government bonds. Number 24, you just need to be able to define what bond duration is. What is bond duration? Okay, make sure you understand the concept of duration, because this is a problem, number 24, that's kind of trying to trick you a little bit. If you don't really know the concept of duration, you might get this one wrong. If you understand the concept or know what the book has to say about duration, you'll be just fine on number 24. Number 25, we want to understand what modified duration is. So just make sure you understand the definition of modified duration. Number 26, we want to understand what the definition of securitization is. What is securitization? Okay. Number 27, we want to understand what the MFCR is for a mutual fund. What is the MFCR? I'm just going to give you the acronym. Look it up. What is the MFCR on a mutual fund? If you know what it is on the test, you'll get it right. That's number 27. Number 28, you want to understand what a unit investment trust is, or a UIT. They're usually referred to as UITs, but just make sure you understand what a unit investment trust is before you get to the test. Number 29, you're going to want to know the difference between different types of mutual funds. You've got basic categories like value funds, growth funds, equity income funds, aggressive growth funds. What are the differences between those basically? Okay, you don't need to memorize a bunch of information about each one of them, but just basically know what the objectives of each one of those are. And they're pretty intuitive, but there's kind of nuanced differences between each one that the book describes that you'll want to know before you get to the test. Number 30 on the test is really intuitive. Okay, don't second guess yourself on this one. Basically, it just is saying if you want to get a mutual fund that's suitable for you that you should invest in, we need to understand what your objectives are so we can match those up. It's kind of similar to a question we've already seen, basically, that is, whenever the test is asking you whether or not you should understand objectives and suitability before you buy something or before you do something, we're going to go with that, right? The answer is true. You should always know what your objectives are before you do something, before you pick things out. And if it reverses that, if it says, you should pick things before you know what your objectives are, the answer is that's false, right? We should never do that. So number 30 and then a previous question on the test, both are kind of that intuitive strain of just make sure you understand the objectives that you have for investing before you actually pick individual investments. Number 31 on the test. Number 31 on the test has to do with how we calculate options returns. Okay, you'll remember when we talked about stock and mutual fund returns, we talked about how there's a holding period return, or an HPR, that involves both income and value change. But when it comes to options and futures, we only are calculating based on a value change. We don't have an income component when it comes to options. Okay, so that's a little bit different for number 31 on the test, something we need to understand for the test. Number 32 on the test. Number 32 on the test basically is it goes off of just what I just barely mentioned from 31, which is when we talk about holding period returns for stocks, bonds, and mutual funds, we're talking about total return of both income and value change. Okay, that's the holding period return for stocks, bonds, mutual funds, normal investments. Okay, but when we talk about options and futures, remember for the previous question on number 31, we need to remember that we don't account for interest income when it comes to options and futures. We only account for value change. Okay, so that's kind of a nuanced difference between options and futures and regular other investments. Number 33 on the test, need to know how to calculate the dividend yield on a stock. How do you calculate the dividend yield on a stock? You're not going to have to do the calculation. You just need to know what the equation is. You just need to know what the inputs are. It's a very straightforward equation, so don't worry that you're going to have to memorize some big long equation. But it's a basic equation that if you understand before you get to the test, you'll get number 33 right. How do we find the dividend yield of a stock? Number 34 on the test, the answer is A. Okay? Those of you who listened to the very end of this, it's a pretty complicated question, so you'll appreciate the fact that you've got number 34 right. And don't need to worry about number 34. Number 35 on the test. Number 35 on the test, you just need to understand what the book defines a commodity as, how broad or how limiting the definition of commodity is. You'll recall that we looked at a graphic tonight that listed the different futures contracts that you could do it on. And there was like foreign currency and markets. It wasn't just commodities, right? So when we talk about commodities, sometimes we use a very broad definition, and the book in this case used a very broad definition in this last chapter we looked at, chapter 15, that includes all kinds of commodities and things we don't even really think about usually as commodities, okay? You need to understand for commodities trading what open interest means, okay? So commodities trading, what is open interest? What is open interest? If you know what that is, you'll get number 36 right on the test. Just look what the book has to say in chapter 15 about what open interest is on commodities futures trading. Number 37 on the test is true. And number 38 on the test is false. Okay, so according to my calculations, you've all got 3 problems right. Based on your notes, I've given you answers to at least 3 problems. The rest of them, I gave you the answers to many of them just in my description of what you needed to think about for those topics. And some of them, you just got something very straightforward that you need to go to the book and make a note on before you get to the test. You should be in great shape for the test this week. I hope you feel very comfortable and confident by the time you get studied, by the time you study this stuff up, look to the notes, but it should be a fairly straightforward test as long as you've done your homework. Have a great week this week. Make sure that you get caught up as fast as you can. Make sure that you get all your checkpoints, stay on top of that. Be sure that if you're missing a discussion board comment or 2, that you just get them done. It's such an easy thing for a few extra points to just go in and add a comment, okay, a response, something like that. Or, complete last week's assignment that we went over tonight. That's just such an easy thing now that we've reviewed it. Maybe you need to listen to our session a couple times, or the part that we cover that a couple times, but you're going to be just fine. Saturday is the last checkpoint, if I'm not mistaken, Troy. So depending on your grade after you take the final, you can choose whether or not to continue with checkpoints, right? Let's say you take the final on Wednesday, and because of your score on the final, you've got an A in the class. You don't need to worry about checkpoints the rest of the week then, okay? So it's kind of nice to do the final a little bit sooner in the week if you have the time to, because then you have an idea of, first of all, whether or not you should be in touch with me, whether or not we should communicate about what you should do, right? But second of all, so that you can plan accordingly, do some extra checkpoints, resubmit an assignment, do some extra work on discussion boards, that maybe you missed on some things. Those kinds of things are things you can do after the fact if you know what your final score is. if you wait until Saturday night at 11:50, it's too late. There's not anything we can do about your score at that point. Okay. All right, everybody. Have a great evening. Good luck this week, and hopefully, I wish you the best of success going forward with your future courses. There is that short quiz. Just keep in mind there's that short 3-problem quiz that asks for feedback on the course, things that we can do better for future courses, asks you to be positive, but just give any honest feedback that you can, and you'll get that 15 points that's available to you on that one as well. Okay. All right, everybody, have a good night. Hey, thank you, Frida. Have a good night.